All right, let's dive into something that's, well, it's a real head-scratcher. We're talking about AMC Entertainment. You've got a company with a genuine, certified blockbuster hit, but if you look at its stock price, you'd think the exact opposite was happening. So today, we're going to dig into the bullish argument from our source material and try to figure out what might be going on behind the curtain.
Okay, I want to start with just one number, a big one, $915.8 million. Just let that sink in for a second. Now, a number like that is pretty meaningless without context, right? So let's add some. That's the amount of money a single movie, Zootopia 2, pulled in at the global box office. And get this, it did it in just 12 days. The source we're looking at really hammers this point home. We're not talking about a slow burn here. This is lightning-fast success. It's a huge, undeniable signal that people are flocking to the movies. And that's where things get weird. It's the central question we're tackling today. How can a company have a nearly billion-dollar win on its hands, and its stock just sits there? It feels totally disconnected. So what is really going on here?
Okay, to even begin to understand this paradox, we have to start with the basics, with the foundation of the whole bullish case. And that's the good news. And believe me, the good news is really, really good.
Look, this is about way more than just ticket sales. The source talks about this huge ripple effect. First off, Zootopia 2 is on track to hit $1 billion faster than Inside Out 2, which was a monster hit. A massive chunk of that, we're talking over $430 million, is coming from China alone. That tells you this isn't just a domestic success, it's a global phenomenon. And you know what happens when people go to the movies, right? They buy popcorn, they buy soda, all that high-margin stuff that's the real moneymaker for theaters. So this is a direct shot of high-quality cash right into AMC's bank account, something that's going to show up on their earnings reports for the end of 2025 and into 2026. From a fundamental standpoint, this is an absolute home run.
So you've got all this great news, all this cash pouring in. You'd think the stock would be taking off, right? Well, it's not, and that's the paradox we really need to dig into. It really is a tale of two completely different stories. On one hand, you have the fundamentals, record-breaking revenue, proof that people want to go to the movies, and a healthier balance sheet. That story is bullish, no question. But then you look at the market story, and it's all about a stagnant stock, investors getting tired, and this narrative that it's a dead company. These two stories, they just can't both be right. They don't add up.
So, which is it? If the business fundamentals are this strong, why isn't the stock price moving? Well, the source material we're looking at has a pretty fascinating theory about that.
The theory goes like this. While everyday investors might be feeling fatigued, the big players, the whales as they're often called, are doing the complete opposite. They're not selling, they're buying, quietly accumulating absolutely massive positions.
So how do we know this? Well, the evidence comes from these things called 13F filings. Now, it's really important to know what these are. Think of them as a quarterly report card for huge investment funds. They have to disclose what they've been buying and selling. The catch is, it's a delayed snapshot. It tells you what they did last quarter. But it gives us this incredible peek behind the curtain to see what the so-called smart money is up to.
And when you look at these filings, wow, the numbers are just staggering. Check this out. Marshall Wace upped its position by, wait for it, 17,925%. That's not a typo. That's not just tweaking a position. That is a massive all-in kind of move. Then you have UBS Group up over 4,500%. I mean, come on. These are not the moves you make if you think a company is on its last legs.
And it's not just the aggressive hedge funds either. Even a behemoth like Vanguard, which is usually more of a passive player, jumped in and added another 5.7 million shares. When you see buying like this from all different types of institutions, it really suggests there's a strong, shared belief that something's about to happen.
Our source really puts a fine point on it with this quote. The argument is simple. Big money institutions do not pour millions of dollars into a company they think is dying. The claim is that they are setting the board, getting ready for what the source calls a violent move upward. They're betting that eventually the stock price has to catch up with reality. Okay, so that brings us back to the big question, right? If these whales are buying up millions and millions of shares, why isn't the price going to the moon? Well, according to the source, there's a very specific mechanism that lets them do all this buying kind of in the shadows. And here's the key piece of the puzzle. The data our source points to shows that a whopping 76%, more than 3 out of every 4 shares of AMC, are being traded off exchange. These are often called dark pools. Basically, it means the trades are happening privately, away from public stock exchanges like the NSY, where you and I see the price tick up and down.
And this, right here, is the core of the argument. The source claims this is how the price is being held down. These big institutions can go into these private dark pools and buy massive amounts of shares without anyone seeing it. There's no big buy order on the public market to push the price up. It's how they can apparently build their positions without tipping their hand. This is the alleged secret ingredient to the whole paradox.
Okay, so we've got strong fundamentals on one side and this alleged secret institutional buying on the other. What does that mean for you? What should you be looking for? Well, the source actually lays out a couple of practical scenarios, a kind of strategic guide.
First up, let's talk about the Green Day plan. This is the bullish breakout scenario. The magic number to watch is $2.35. The idea is if the stock can push above that price on a high volume, and this is key, if it can stay above it for about half an hour, that's your confirmation. That signals the momentum is real, and the next stop could be the 250 resistance zone.
But what if the price goes down? Well, there's a plan for that too, which the source calls the bear trap. This is where you might see a quick, sharp sell-off, maybe down to the 220 to 225 range. Now, according to this theory, that's not a sign of weakness. It's the institution supposedly shaking the tree, pushing the price down just enough to trigger people's stop-loss orders so they can buy up those shares on the cheap. So what you'd look for is a sharp V-shaped recovery right after that dip.
So let's just put all those numbers together so it's crystal clear. We're starting around 233. The key level to break, the lid on the price, is 235. The first big target on the upside is 250. And if it drops, that 220 level is what the source calls the institutional floor, the key support zone. And way down at 205, that's the 52-week low, kind of the ultimate line in the sand. So there you have it. That's the map of the battlefield as laid out in the source material.
And that brings us right back to where we started. You've got a billion-dollar success story on one side and a stock price that's going nowhere on the other. So what is it? Is the market just broken, or are we seeing a massive calculated strategy playing out right under our noses? That, right there, is the billion-dollar paradox of AMC.